The billionaire buys a private jet. The billionaire buys a football team. The billionaire buys a yacht that costs more than your entire street. But here's what the billionaire never buys: a lottery ticket, a cryptocurrency that their nephew told them about, a single stock tip from a mate at the pub. That's the rule. And it works exactly the same on a normal Australian salary as it does on a billion-dollar fortune. The Australian Securities and Investments Commission says over 5 million Australians hold shares outside of super. But here's the kicker. Most of them are picking individual stocks like they're at the Taibbi. Look at ASIC's own data on retail CFD traders. In the 2023 to 2024 financial year, only 32% of retail clients made money after fees. The rest? Well over 100,000 Australians lost more than $458 million between them. Meanwhile, the billionaire is doing something so boring, so predictable, that it almost hurts to admit. And the gap between what they're doing and what you're doing? It's costing you hundreds of thousands of dollars across your lifetime. What is the one rule that bridges billionaire wealth and your weekly paycheck? You've probably heard that rich people get rich because they take huge risks. They bet big. They gamble on startups. That's what the movies show. That's what the news sells. It's almost completely backwards. The billionaire understands something that most middle-class Australians never get taught. Wealth isn't built on winning big. It's built on not losing. ASIC's own figures on high-risk trading accounts tell the same story. Most retail traders are losing money after fees, not beating the market. The system wants you to think investing is complicated. The billionaire's rule proves it's not. You've been sold complexity. You're about to get sold simplicity instead. Part 1. The 70% rule that changes everything. Here's the rule the billionaire uses. They own the entire market, not a small piece of it. They buy index funds. They buy exchange-traded funds, ETFs, that track the entire Australian and global economy. In America, the average billionaire like Warren Buffett recommends the S&P 500 index. In Australia, the equivalent is an ETF like VAS that tracks the ASX 200, or a global fund like VGS that covers the whole world. The rule is simple. You own the top 200 companies in this country, and you do it at a cost of less than 0.1% a year. Contrast that with the average Australian who picks 3 or 4 stocks they heard about on the news. One investor, let's call him Mark, puts his money into a combination of VAS and VGS. Over 10 years, the ASX 200 has historically returned around 8 to 9% per year on average. Another investor, Paul, picks his own stocks. He gets caught up in the hype. He buys a mining stock that looks hot, a tech stock that his cousin recommended. 10 years later, Paul's portfolio is up 30%. Mark's is up over 100%. Same salary, same starting point, but Mark owns the entire economy while Paul owns a bet. The question is, what do you actually own right now? A bet or the economy? Part 2. The time bomb. Most Australians ignore. This is where the billionaire's rule gets uncomfortable, because the second part of the rule is time in the market, not timing the market. The billionaire doesn't try to buy low and sell high. They don't check their portfolio every morning at breakfast. They just keep buying consistently, relentlessly, regardless of what the news says. The average Australian investor, by contrast, sells when the market drops. The Australian Securities Exchange, ASX, has tracked investor behaviour during downturns. When the market fell during COVID, something like 40% of retail investors sold out of panic. The Australian Bureau of Statistics data shows the market recovered within a year. Those who sold locked in losses. Those who held made their money back, and then some. Consider two investors. Sarah invests $5,000 a year into an index fund without fail. She doesn't watch the news. She doesn't panic. She just buys every month automatically. Emma invests $5,000 a year, but she panics. She waits for the right time. She gets out when the market drops. Over 20 years, Sarah's portfolio grows to over $300,000, assuming average returns. Emma's portfolio, because she mistimed the market repeatedly, grows to just over $200,000. That's $100,000 lost because of a behaviour, not a lack of money. The billionaire doesn't panic. So why do you? Part 3. The Aussie tax advantage. Nobody talks about now. Let's talk about the tax secret that makes this entire rule even more powerful for Australians. Franking credits. You've probably heard the term. You may not understand how much it's costing you to ignore it. When an Australian company pays tax on its profits, it passes a credit to you, the shareholder, to stop you being taxed twice. If you own Australian shares directly or through an ETF like VAS, those franking credits land in your account as a tax offset. If you're on a salary of $80,000, a portfolio of Australian shares generating fully franked dividends can save you thousands of dollars in tax every year. The ATO reports that Australians claimed over $11 billion in franking credits in the last financial year. But most Australians don't claim them properly because they think investing is too complicated. Two investors. Both earn $100,000 a year. Both have portfolios of $100,000. Investor A buys Australian index funds with franking credits. The franked dividends generate about $4,000 a year, and the tax offset reduces their tax bill by around $1,700. Investor B buys international stocks without franking credits. They miss the tax benefit entirely. Over 10 years, investor A is ahead by over $30,000 just from the tax advantage. That's free money from the government that most Australians simply don't know exists. The billionaire uses every legal tax advantage available. The question is, are you using yours? Here's what you need to take away from this. The billionaire's money rule isn't about having more money. It's about having a better process. Own the entire market through low-cost index funds. Stay invested regardless of the noise. Use every legal tax advantage available to you. That's it. That's the rule. It's not sexy. It won't make you a millionaire overnight, but it will make you a millionaire over time. The gap between the Australian who retires with $600,000 in super and the Australian who retires with $2 million isn't a gap in income. It's a gap in behaviour. It's a gap in understanding the simplest, most powerful investment rule on the planet. You don't need to be a billionaire to use a billionaire's rule. You just need to stop acting like a punter and start acting like an owner, because the economy grows over time, and if you own a piece of it, you grow with it. So here's the question. Are you going to keep betting against the economy, or are you finally going to join it?